Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler, Evan Barnard. There's something inside of all of us that wants to know that we're doing the right thing for our family. And there's another centeredness to that.
Right, yeah.
And, when I look at when I'm, depression, for example, and it's been said that it can be excessive self-focus. What am I not getting? What am I not achieving? What am I not, what's not going well for me? And often you have to go, okay, wait a minute, let's get outside of thinking about, yourself. How can you serve other people is a jump start to getting away from that.
Yes, and gratitude.
Yes, yeah, for sure. Yeah.
Making a conscious effort to actually see what you're really, should anyway, be thankful for.
Yeah, there's a good app. It's probably still out there. 3 Good Things.
Oh,
I think it's what it's called. And every day you sit down and you write 3 good things that happened to you that particular day. To get you focused on that. Because a lot of the self-talk that we have, I'm not doing it. I can't do it. I don't have the ability. And we can talk ourselves straight down.
Yes.
We can really talk ourselves into a funk in a big heartbeat. Yeah, it's good stuff. Speaking of funk, there was an ice hockey player who nailed this year's AI trade.
Oh.
Switching gears over to investing. And I thought, what a bunch of nonsense. Nailed this year's AI trade, and this guy, hedge fund and all of this stuff. And I thought, why in I guess it was a Smart Money magazine or something. It was Wall Street Journal. Why highlight a person like this?
Right.
And the reason being is that it actually appeals to greed that I can do this, I can hit it big and I can get rich. And they had some guy that, had a 60% return this year through November and just nailed it. And I thought this kind of stuff drives me nuts because this is the same stuff I saw in the late 90s. Where people, hey, look what's going on. What's going to happen? Who's getting it? Who's hitting it? And it is a big myth of investing. Investment firms, folks, will play to you and show you their wins. And you know what? Your friends will do the same thing.
Yes.
Your friends will do that because they want you to show how smart they are. They want you to know how good they are. And when I just read that article, it made me just go, I hate when that stuff happens. There was another article that was about private funds. This is something that we're seeing more in 401ks. And it was, I don't know if you saw this, Evan, but it was when your private fund, I knew. I just looked at you. I knew you had to have it. So when your private fund turns $1 into 60 cents.
Gosh.
Your thoughts?
Well, I knew I had this. And when you were talking earlier, maybe even last hour, on target date funds, and now they're starting to add private equity and so forth, I was just thinking that they're not helping investors at all by adding this. And to me, the guts, and you may want to be pulling out other stuff in the article, but to me, the guts of the point was a lot of stuff in private equity is not disclosed. And so the minute that this, and how the dollar went to 60 cents is this fund went public, and all of a sudden it lost 40% of market value because they had now disclosed, well, here's what's in here and so forth. And once you've got that regulatory scrutiny and that visibility, the market will price what they think that thing is worth. And there is something to be said for investor protections and visibility and transparency.
Well, I took away something different, from why it dropped so much in value.
Yeah.
And I think it has a lot to do with Adam Smith's Wealth of Nations. What did he say were the 2 things we needed to have efficient markets? Ease of information.
Yeah, information.
Ease of information, ease of transaction. And I think because they weren't really clear. They were talking about the net asset value, and they said it turns out to mean not actual value. They were joking around what the acronym really was. That's a hard lesson in recent week from funds that invest in private assets. But what I took away from this is that when you look at an asset like this, a private equity asset, back when it was not held inside of a 401k. Now, private equity, when it goes into 401ks, here's my beef. It is still going to be private equity. They're still not going to be disclosing the earnings. They're still not going to be disclosing the cash flows. They're still not going to be disclosing a lot of things. It's still going to remain private.
Right.
And the thing that gets me is that now what has changed is the number of people voting on what it's worth is what hit me.
Yeah.
And maybe you and I are saying the same thing.
I think we are.
No, we are. Okay. All right. Maybe I misunderstood.
No, that's okay.
But that was the thing is that when you have, like, for example, you'll see a company that is, you work for a company and you have an ESOP, an employee stock ownership program.
Yeah.
And they'll come in and they will do an audit of the company's value. Now, they'll have a group of people that are really smart. I mean, they're really smart coming in and saying, okay, what are your cash flows? What's your market? What's the EBITDA? And all of that stuff. They're going to use all these fancy terms that you're sitting and go, I don't know what that is. They're going to look at your book value of your assets, and they're going to be looking at all of these metrics, and they're going to determine what your company is worth. And they're going to come out and say, well, your company is so many dollars per share, and if you want to put money in, that's what you pay. If you want to take money out, that's what you sell it for. And it's whatever their determined value is. Now, imagine that not just the number crunchers in the company and their auditors and their accountants are looking at the books and whatever information they can get access to. Now everybody is out there. And now the whole of the investor population, who now brings another part of the information or part of the puzzle to the party. And the part that the general public brings to the party is tastes. Do I like what this company's doing? Do I think that they have a future? Do I know something about their competitors that maybe those number crunchers don't know?
Yeah.
There are a lot of extra information is now coming to bear inside of pricing that thing. And what they're finding is this: they're transitioning from in these programs, and they're collapsing as soon as the portfolios were exposed to public markets, is what they found. And they said they had in December 16th, what used to be traded as what used to be a non-traded portfolio, it was a real estate portfolio, began trading in the New York Stock Exchange, and with the stated net asset value of $24.36 per share, 36 cents per share. The fund closed at $14.70, 39, about a 40% discount from net asset value. And bam, that was it. And, then they said, for every dollar the fund said that the shares were worth at 9:30 in the morning, the stock market was willing to pay only 60 cents at 4 p.m. at the closing of the market. And he said, here's the thing. You don't need a class in economics to know the most fundamental fact about prices. And it's that any asset, it's only worth what you can get somebody else to pay for it. Does this sound familiar?
Yeah. Well, and
Bitcoin, by the way, for those of you that doesn't sound familiar, gold, for those of you who don't know.
Yeah, pet rocks,
Yeah, for sure. I mean, whatever.
Meme coins, yeah.
Beanie Babies.
The gorilla, whatever Jim was talking about, the gorilla thing from the meme stock.
Yeah. Right. Yeah.
But to me, I mean, the point is, and it's, you think back, maybe even the first Trump administration, and all of the legal stuff related to his real estate holdings and the court going, well, you valued it at this. To me, I kind of see this as the same thing as the private equity guy says, well, it's worth $100 million. Until someone looks at it and says, no, it's not. It's worth $60 million. Then they're carrying it on their books as $100 million. They could say it's worth $500 million.
Yeah, we call that mark to market.
Yeah. And so, I think that's the other thing is that initial value to me is artificial. And I think we're agreeing. The minute the market has the ability for 100 million people to look at this,
So true.
very quickly they're going to say, "Oh, this is what it's worth."
Yeah,
And it doesn't take long.
No, that's exactly right. And they will see things that a handful of auditors and accountants won't necessarily see. So true. And they said it's hard to overlook the irony here. For years, managers of these funds have been marketing them as a way to escape volatility of public markets. And they basically said, oh, you know what? These things don't move as fast. You know why they didn't move as fast? It's because the public wasn't determining the value. Mm-hmm. I'll never forget this one guy coming in here one day. His accountant sent him in here. And he comes in, and it was, I won't mention the company, but he comes in and he says, my accountant told me to come in here and talk to you. I said, okay, smart accountant.
And he goes, said that, Paul.
And he goes, my company's going public.
Oh,
is what was going on. My company's going public.
Yeah.
And I said, okay. And he says, I have $3 million, I think it was something like that, in stock in this company. I said, okay. And he says, my accountant says I need to talk to you, and I don't see what I need to talk to you about. And so I walked him through how markets worked. And he said, I said, here's what's going on. Your company used to be private. And he said, yep. And its stock went up every year. Every year it went up. And I said, yeah, you know why? He goes, because it's a good company. I said, yes, it's a good company, but that's not why. I said, because you have a small group of people determining the value. I said, mark my words. Now that it's public, it will be all over the place. And guess what? He didn't listen to me. Guess what? Yeah, I know. It's sad. It's really sad. You know what happened? Crash. Crash. 6 months later. But over and it just didn't take very long. As soon as that sucker went public, about 6 months later.
Yep.
Because we were talking before it went public. He and I were. As soon as it went public, boom, down. And I was like, well, see, I told you so. I knew it. But did
he come back in?
No.
That's a shame.
No, well, a lot of people won't. Yeah. And the reason is because, doggone that idiot Paul Winkler was right. I can't admit that it was wrong. He's like Fonzie in Happy Days. I was wrong.
Yes.
Those of you old enough to know that episode when Fonzie couldn't admit he was wrong. But, I never hold it against people. I was just going, you know what? We don't know what we don't know. And we make mistakes. People do.
And to me, it's important to say, none of us here want to see clients lose money. No. So we take no joy in seeing people get crushed doing these mistakes. That's why we talk about it all the time.
So true.
It's not to be right, it's to save investors.
Right on. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.